Imagine this. You spend decades meticulously building up your retirement savings. You even hire a lawyer to draft a flawless last will and testament. And then, all of it is completely overwritten by a single, dusty form you signed 20 years ago. Well, welcome to The Explainer. I'm your host, and today we're tackling a massive but seriously overlooked financial blind spot: how to properly add and manage beneficiaries on your Wells Fargo accounts. If you want to actually protect your financial legacy and make sure your money goes exactly where you want it to, you are absolutely in the right place. So let's dive right in.
Could your ex-spouse legally inherit your entire retirement? I know it sounds crazy, but the shocking reality is, yes, they could. Think about it. If you named your ex as the beneficiary on a 401k or IRA when you first opened it, and you never got around to updating that specific form, they could literally walk away with everything when you pass away. And get this, it doesn't even matter if your divorce decree or your newly updated will says otherwise, the beneficiary form almost always wins out.
And this brilliantly illustrates the legal reality we're dealing with here. As scholars from the Cardozo School of Law point out, and I quote, "The account holder's beneficiary designations often trump express provisions in a will, trust instrument, prenuptial agreement, or divorce decree." That's intense, right? We're talking about a phenomenon they call accidental inheritance. It basically happens when outdated forms end up dictating the future of your assets, totally bypassing all your careful estate planning.
So here's our roadmap for today. First, we'll look at the accidental inheritance trap. Second, we'll break down understanding POD and TOD. Third, the actual steps to add beneficiaries. Fourth, avoiding common pitfalls. And finally, fifth, securing your financial legacy.
All right, kicking things off with Section 1, the accidental inheritance trap, and exactly why your will just isn't enough.
To really understand the scale of this problem, just consider this number: $9 trillion. That is how much wealth Americans currently hold in retirement savings accounts right now. That's a lot of zeros. So this isn't just some niche issue for the ultra-wealthy. For the vast majority of working and retired Americans, these accounts, along with their family home, represent their absolute most significant assets. And the wild part? The rules governing them bypass the traditional probate court system entirely. You see, those researchers at Cardozo Law actually refer to this as the hidden law of succession. And why is that? Well, because you usually fill out these beneficiary designation forms on your very first day of a new job, or maybe when you're just rushing to open an account at the bank. You know how it is. You're focused on HR paperwork, not your long-term estate planning. And because these forms are basically invisible contracts between you and the bank, they bypass the whole probate process. So if you forget to update them, your money might go to someone you designated literally decades ago.
Moving right along to Section 2, understanding POD and TOD. These are really the keys to the vault.
Okay, first up is POD, which stands for Payable on Death. This applies to your standard consumer bank accounts at Wells Fargo, so your checking, savings, and certificates of deposit. When you add a POD designation, you are essentially putting an invisible shield right around your money. While you're alive, the beneficiary has absolutely zero access to your funds and zero legal claim to them. You could spend it all or change the beneficiary tomorrow if you wanted to. It only activates upon your passing, transferring the exact balance directly to them and skipping that lengthy probate court process entirely.
Now on the flip side, TOD stands for Transfer on Death. This is a parallel designation, but it's used for your non-retirement brokerage and investment accounts, like the ones managed through the self-directed Wells Trade platform, for example. It works just like a POD, but it's governed by securities law instead of banking law. Essentially, it allows you to transfer your stocks, bonds, and mutual funds directly to your named beneficiaries without those frustrating delays of probate. Now, there is a totally critical distinction we've got to make here. A huge source of confusion, especially for beginners, is mixing up estate beneficiaries with transactional pays. Estate beneficiaries, so your PODs and TODs, they inherit your money after you pass away. Transactional pays, on the other hand, are just the people you add on the Wells Fargo app to send money to right now using things like Zelle, wire transfers, or Express Send. So just to be super clear, adding a friend to your Zelle account definitely does not mean they inherit your checking account. All right, let's get into the practical stuff in Section 3, Steps to Add Beneficiaries, and how you can actually take action at Wells Fargo. So, for your everyday checking and savings accounts, the absolute most secure method is an in-person branch visit. Here's how you do it. Step 1. Go online and schedule an appointment with a Wells Fargo personal banker. Step 2. Make sure you bring a valid government-issued photo ID. Step 3. and this is crucial, you need to bring verified data for your beneficiary. Specifically, they'll need their full legal name, date of birth, social security number, and mailing address. And finally, step 4, you'll sign an updated signature card right there at the bank, locking in that payable on death designation.
Now, if you prefer to handle things from the comfort of your couch, Wells Fargo does provide a secure digital alternative. Step 1, just log in to your Wells Fargo online portal. Step 2, navigate over to the Customer Service tab and select Forms. Step 3, you are looking for the designation of beneficiary PDF. Step 4, you can actually fill this out digitally using 256-bit data encryption, which is great because it protects those highly sensitive social security numbers. After that, you just securely upload it right through the portal, or, you can always print and mail it in if you prefer. Now, if you happen to have an individual retirement account or an IRA, the rules are just slightly different. You actually have to use a specialized IRA designation of beneficiary form. But there's a really great feature here called the per stirpes election. It's a fancy legal term, but it basically means that if your named beneficiary happens to pass away before you do, their share automatically goes down the bloodline to their children rather than being split among your other surviving beneficiaries. Also, just keep in mind that when your beneficiaries do eventually claim these IRA funds, they're probably going to need a medallion signature guarantee. That's just a special fraud prevention stamp from a bank that goes right on their claim form.
Let's move on to Section 4, avoiding common pitfalls, so you can keep that invisible shield completely intact.
Okay, here are the absolute best practices you need to follow. First, always name a contingent or backup beneficiary, just in case your primary beneficiary passes away first. Second, you must update these forms immediately after any major life events. We're talking marriages, divorces, or the birth of a child. Like we saw earlier, forgetting to update after a divorce is a classic but totally catastrophic mistake. Next up, try your best to avoid naming your estate as the beneficiary, because doing that forces the money straight back into that slow, really expensive probate court process. And finally, if you have a joint bank account with your spouse, remember that the money automatically passes to the surviving co-owner first. The POD beneficiary only actually takes effect after the very last co-owner passes away.
Another huge pitfall is just ignoring tax laws, which, let's be honest, change constantly. For example, beware of the Secure Act of 2019. If you leave an IRA to a non-spousal adult child today, they no longer have their entire lifetime to stretch out that tax burden. Nope, they now have just 10 years to completely withdraw and distribute those funds, which could significantly impact their taxes. This is exactly why keeping your designations current and consulting a professional advisor is just absolutely crucial. And that brings us to our final segment, Section 5, Securing Your Financial Legacy. Ultimately, a well-structured beneficiary plan efficiently divides your wealth. You can actually assign specific percentages to multiple different beneficiaries, which ensures your assets are distributed strategically exactly the way you intend. And because these designations completely bypass probate, you are giving your loved ones really rapid, private access to funds when they might need them the absolute most, all without the massive headache of court delays.
Now, before we officially wrap up, I do need to give a very important disclaimer. I am an enthusiastic explainer, for sure, but I am not your personal lawyer or accountant. This explainer is an educational guide based on standard procedures. Because beneficiary rules and tax laws can vary pretty heavily depending on your state and your own unique personal situation, you really must consult Wells Fargo directly or speak with a certified tax or legal advisor to get the most accurate, personalized advice for your estate.
Which brings us to our final thought for today. I want you to ask yourself honestly, when was the very last time you checked your beneficiary forms? Was it 10 years ago? Maybe before your last child was born or before a divorce? Please don't let accidental inheritance dictate your legacy. Log into your accounts or call your bank and check your status right now. Thank you so much for joining me for this explainer, and happy planning.